Hi, this is Pat Moorhead with More Insights and Strategy, and we are here for another awesome Fintech Friday with principal analyst of Fintech, Melody Brew. Mel, how are you today?
Crazy, but good. It's been a crazy week, hasn't it?
It really has, but I feel like every week is crazy. And at this point, 10 years into More Insights and Strategy, really the only thing that stresses me out is when I'm behind on writing. It's so weird. Like that's it. Sweating some consulting deal or advisory. It's like, no, nope, nope, nope. Just getting behind and serving clients is the number one stressor for me when I get behind. Because quite frankly, when I give, a date or something like that, I like to actually hit it. Maybe it's the Midwestern in me. I have no idea, but it is what it is. So.
Yeah, well, whenever I'm really busy and stressed out, I just think about what you do, and I'm like, it's not. I'm just having a Pat day. That's all.
No, I
No big
appreciate
deal.
that. Well, it's crazy when I don't get busy. I find other stuff to make me busier, which it just can't be. It can't be good or it can't be healthy. So I think I need to go see Dr. Vic. But enough on that later.
He's the best.
So we have a great show today. We have some fun stuff. We've got Fly Now, Pay Later. I can't wait to hear about that. We've got more on the CFPB. We talked about it a little bit last week at our exit, but it's show me the money time. We're going to talk about what's new in the hood, and that's have some really good staying power. Our fans love it, and Robinhood is fun. It's full of controversy all the time.
It's all over the place.
It is. And then we're going to end it with my favorite part of the show, which is always the acronym of the week, which, by the way, last week I embarrassed myself. I actually invest in ETFs. I was thinking of something completely different.
NFTs. Yeah.
I was thinking of NFT. So yeah, I embarrassed myself, but that's the good news is that I am not the principal analyst of Fintech here. It's Mel. So I can do these things, but this one I do understand, and it's API, but I think we need to talk about it because they're becoming increasingly important in Fintech. So let's dive in here. Fly now, pay later. What's going on in travel? Mel, I got to tell you, you impress me with how many things you can wrap around Fintech, and whether it's social media, weed, and weed stocks. I mean, like everything is Fintech, right?
Everything is becoming Fintech. I mean, it's really crazy how many things overlap. When you talk about payments in any sense, almost everything we do involves some sort of payment. So now that all of those payments are the majority are digital, it's going to wrap around every industry. So what's happening here is American Airlines and Affirm, one of the buy now, pay later leaders in space, announced an exclusive partnership where people can actually split their payments on travel. So they basically, it's 3 to 12 months with a fixed interest ranging from 10% to 30% with no late penalty fees. It's really interesting. I think, I've said this before, I feel like the buy now, pay later space is now becoming this really great economic indicator, and it shows us where companies are investing their money in terms of all of these acquisitions, all these deals, plus what are they seeing in terms of consumer behavior that they recognize that they need to be able to offer people ways to pay for. So Affirm data shows that 74% of people expect to travel and spend more on travel this holiday season. So when you think about coming out of the pandemic, of course, people want to travel. They haven't been able to see their loved ones. Like I mentioned last week, I flew to see my dad last week. People are finally to use a Southwest term, free to roam about the country, but and beyond. But of that 70%, 60% of people were concerned that they can't afford it. So this gives people options. It's a tricky thing when you think about what happens in the airline industry with cancellations. You clearly can't return a flight, so how are they going to kind of deal with those types of things that come up? Fees that aren't associated with the actual purchase with Affirm and American, but fees that are associated with travel changes, in terms of, I want to book my flight for tomorrow, I can't leave today. So there's all that stuff that it kind of seems like an unknown for what's going to happen. But it really is showing that, I kind of made a little bit of a comparison of last year at this time, everybody was buying Pelotons because we were staying home and people needed a way. They couldn't even go to the gym. So people needed a way to pay for these kind of higher ticket items. And now we're seeing a shift in that to like lower ticket items, even, with Amazon's deal, as low as $50 to be able to split that out. And so I think, travel could be the new Peloton and buy now, pay later for this year. And I just love the term fly now, pay later.
Can you explain to the audience, maybe some of them are wondering, isn't this kind of what a credit card is for?
It is. And, that's interesting that a lot of the credit card companies are now offering their version of buy now, pay later, where, MasterCard, Visa, they're letting consumers split the payments out without the traditional interest rates that you would pay with paying over time on a credit card. But really, this industry kind of came out of the fact that a lot of millennials don't want to use credit. They would rather just, kind of look at what their spending is for over the next couple of months, break those payments out, but they don't actually want to be tied to a credit card. So, and then there's a second layer of it, which is, people who don't have the credit to even carry a credit card with a limit that they might be able to get from a buy now, pay later provider. It doesn't have the impact on people's credit the way that having a traditional credit card has. So it definitely solves a lot of problems for, people who kind of fly under the credit radar or choose to not have that, the millennials who don't want the credit cards. But, it also poses the risk with that's in that same light where, people can get in over their head financially. I've heard people compare buy now, pay later to payday loans. It certainly is not that. But there's some concern about people spending more, if these people if 60% of the people that want to travel say that they're concerned they can't afford it, it's not up for me to judge, but where's the line between I should do what I can afford or, I can find another way to pay for it. So
yeah, I'm so glad you explained it like that because, it's funny. I was thinking of payday loan or something, and then I was even wondering, well, wait a second, okay, so this doesn't sound like it hurts your credit, but it also won't improve your credit,
right?
If you have a good history or something like that.
Exactly. And so people who don't have the credit history, they're not necessarily building credit with this. And that's where I think somebody is going to figure that out. And that's going to be just a huge advantage for them because so far the big credit reporting bureaus don't have a way to track these payments that is actually advantageous for people's credit. So it doesn't hurt your credit, but it doesn't help it. But that's a whole nother topic we can get into another time, which is all these fintech companies that are actually helping people to build their credit or rebuild their credit. There's actually one based here in Austin that's called Self. We'll have to talk about them another time because I know we're somewhat limited on time today. But there's lots of really great tools out there in terms of credit building. People hate talking about credit, but it's just a necessity in life.
It really is, and it's crazy. Again, here's my Midwest coming out. I was just paying everything off that I could.
Yeah.
And I got to a point where I literally had no credit and I couldn't get a loan. And I was like, wait a second, I'm really good at this stuff. Like I don't use credit cards. I use debit cards. And yeah. I drove my car for a decade. Right. And they're like, we're sorry. You actually don't have any credit and neither has your wife. So I went out and I got a credit card and I got a home loan and I put every car that I could on got a loan. So here I am, the American dream. I've got debt. Yay.
Right. I know. Congratulations.
Congratulations. You're in debt. And I think there's something, this is editorial. There's something wrong with that. And by the way, I also didn't give my give my spiel here that, this podcast is for entertainment purposes, educational purposes only. we're not giving investment advice, and find a pro, even though we are the FinTech Friday show. Okay, back to it. So yeah, let's fly to the next topic. The CFPB, the Consumer Financial Protection Bureau, thank you, is saying, show me the money. We talked about a little bit last time. Mel, what is the update? What is going on?
Yeah, so really what they're saying is show me the money data. And I think this is such interesting timing right now with everything that's going on with Facebook. And, Facebook was actually one of the orders was initially sent to Facebook, but with everything that's going on right now with Facebook and data and people talking about that, I'm sure you probably went in the same rabbit hole I did after yesterday, of just hearing what kind of data that they're trying to collect, they're collecting. And I mean, it's creepy, if you really get too into the weeds on it. But so what this big probe, which we kind of mentioned, late in the show last week, was the Consumer Finance Protection Bureau issued this probe. I didn't have a ton of detail on it because it literally happened like the morning of our last podcast. But now I know that orders have initially been issued to Amazon, Apple, Facebook, Google, PayPal, and Square. So the response is due December 15th of this year, but the relevant period is from January 2019 until end of September of this year. And it includes third-party vendors. It includes anybody who touches product. So it's really, they're really looking to find out what these companies are doing in terms of data harvesting, accessing restriction and user choice, any other consumer protections. So, just again, in terms of timing with Facebook, it's like, well, wow, good. Somebody's got to be on top of this stuff. But, they have a new head there, that Chopra. And, he's tough on consumer protection.
Yeah.
And
so it's just picking on the tech giants. I mean, listen, I think when credit cards were in, let's go back all the way to catalogs, right? The catalogs that got shipped in, Sears Roebuck would sell information to other people, and then you would start getting more direct mail. Yep. And then on credit cards, right? All those types of purchases are sold. None of this is new. What's new here? Is it the speed of it? Is it the, why now?
Yeah, I think, well, the biggest thing is that knowing what we spend our money on is just such a valuable source of data in terms of consumer behavior. And it's being monetized by companies and being used for behavioral targeting around advertising and e-commerce in a way that really wasn't as prolific before, because we didn't have all these machines listening to us and we didn't have as many data entry points that these big companies have. And, it's not necessarily that they're picking on, the big tech companies. It's just that companies like this dominate the large portions of e-commerce and person-to-person payments. So, I actually saw something that Chopra, the head of the bureau, said, which was, lots of small companies do the same kind of things, and if they get caught doing it, they get shut down. If the big companies get caught doing it, they pay a fine and they move on. So they're focusing their protection on the big guys first. But like I said, it does include some of the third-party vendors and stuff. So it could get deeper into those smaller companies, but they're really worried about the big ones that have just this massive amount of data. And there's also some antitrust issues, because all of these big companies are looking to expand their empires and gain greater control into our spending habits. And what we spend our money on tells us a lot about every other aspect of our life. And again, that's why I think buy now, pay later is so interesting, because you can see the trickle effect there.
Wow.
I mean, I heard some weird stuff yesterday, Pat. I don't know if you heard any of this stuff, but I even heard about, if Alexa's listening to you, or if, any of your devices, any of your smart devices are listening to you, they can even hone in on the ambient noise or the level of noise in your home and make a prediction of whether there's some kind of strife in your household, serve you up something, about why your life is miserable. And if you click on that, they're more likely to serve you an ad about a divorce attorney. I mean, it's insane, the stuff that can happen. So I think, just really focusing on how these tech companies can have this insight into our spending habits and what kind of control we need to have over our own data. And making sure that we don't turn in, the super apps and all of that don't turn into this, controlled environment where people don't have a choice of where else they can go spend their money. And even that merchants, are forced into cooperating with, companies like Facebook, because if they don't, they'll be pushed down in the algorithms. So there's just a lot that comes into account here on what they're investigating and what they're asking for. So and it's a short time frame. They want it by December 15th.
Yeah.
So
done a lot of research specifically on Alexa, and I will categorically tell you that there's no data transmitted unless you use the keyword. But once you use the keyword, and there's also settings where you can do the follow through, but you have to have that happen. So it's I get your macro point. And I can't speak for Google or Apple in how their smart speakers work or stuff like that. But yeah, it's funny. It seems like sometimes I think our world's best engineers are focused on advertising.
Yeah.
When you think about it, one of the interesting things about these VR headsets is it can actually tell the advertiser how long and which ads you specifically looked at and in which order. So it's one thing to click on something, and CPM based advertising kind of went by the wayside because you couldn't tell if somebody even looked at it, right? But
Right.
the advertising opportunity here is that you can actually see what they look at, right? So it opens up for stuff like brand advertising in particular, it actually gives you metrics there. Not that I'm an advertising or anything like that, but eye tracking is paramount here. So people shouldn't be too surprised why Facebook, excuse me, Meta. So let's jump into the next topic here. I think we squeezed a lot out of the CFPB here.
Yeah.
They're squeezing others. Let's jump into Robinhood. So we've talked about Robinhood about, I don't know, 3 or 4 times. Just a fun company to talk about, and whether they're giving free trades and in exchange for data to people who would like to know what kind of trades are lining up early, so they can short stocks, go long on stocks. Oh gosh, am I coming off like editorial? I am. I'll pay my $5 on E-Trade. So
yeah.
What's going on?
I like this timing just because I feel like it has been a while since we've talked about Robinhood, and there was so much happening in the this sort of meme stock frenzy. But so they just had their earnings, and they missed analyst predictions on almost all their key metrics. They posted a loss per share of $2.06 compared to the loss per share of half a cent in the year ago quarter. They just missed. So yeah, there's a really good indication of what's happening there. They missed expectations on revenue, monthly active users. So there's just they're definitely in a slump, and a lot of this has been driven by crypto trading is down, so that's going to contribute to their weak revenue numbers. They just kind of have it was just a really disappointing earnings.
My gosh, so they're actually below the looks like they're below the IPO price.
Below the IPO price, yeah.
You said that already, but it's like, whoa, hold on for dear life. Hodl.
And I think, actually, I should know these numbers, but it's somewhere like they went from like 5 million new customers to 600,000 in just one quarter. So the number of new customers they're having, the number of the interaction that they're having with this customer, and just their active users, it's just dropping dramatically because there's not this like kind of frenzy of meme stock or whatever that's going on. And the crypto, everything with crypto that's happening, everything that's, I know, and I think there's got to be some, a lot contributing to this in terms of their payment for order flow issues that they're having. But, I think for so much of the past year, we've been saying that, not we, just personally, but people have been saying Robinhood is just seemingly untouchable. But this shows that, they are just as prone to some market swings as the stocks that they sell on their platform or that they allow trading on their platform. And it's a pretty bleak outlook right now because they don't have
I'm
much.
sorry. Here I am surfing the web on our live podcast here.
Oh.
Yeah, I mean, this is what happens. This came in an hour ago. I mean, you have a massive drop like we talked about, and there we go. Right. It's the first story there.
Absolutely.
Anyways, it's kind of ugly. So what do you think? What's the prognosis? I mean, are they fulfilling a long-term need, or is just kind of transitory until maybe they find the next new thing? I remember when everybody said E-Trade was so risky because, my gosh, you didn't have anybody to help you put in that order or talk you through that, right? And it was looked at as crazy and risky, and it was part of .com 1.0.
Yeah.
Think.
I think that, they're sort of subject to just the frenzies that happen in the market. And so they're going to have big ups and they're going to have big downs. And I think what their challenge right now is going to be to manage that from an investor perspective. And, the big issue here is that they didn't meet any of their predictions. And so, they can have as many, warnings and disclosures and all of the things of, what is going to affect their business. But ultimately, if they can't drive the revenue, it's got to have their investors pretty shook at the moment. But, they're kind of becoming that they're prone to the same, meme activity that they've benefited from.
Oh, that's meta. All right. That's pretty wild. All right. Good breakdown of what's going on with Robinhood. And let's go into what I consider my favorite part of the show, and that is the acronym of the week, API. I won't, by the way, if you're in tech and you don't understand this, you should probably get out of tech. But there's obviously a reason that you chose this. It must be important here.
Yes. So, it's so funny that I have thought about using this as one of the acronyms before. And I was like, it's so obvious, but it's really not when you consider the impact it's having on financial services at the moment. And, there might be some people who don't know what it is, but, an application programming interface. And basically it's just, this obviously, but just for anybody, say, somebody, if my Aunt Barbara's watching and she wants to know what this is, it's a dedicated interface that allows people to share data. But I think the reason why this is really important in terms of banking and fintech is it's giving a lot of financial services companies the ability and the security to interface with more fintech companies. And I think most people are probably aware of Plaid. If you're not aware of it, you've used it before. When you are asked to enter in your banking credentials into an API rather than go onto your bank's website and share your credentials, which is called screen scraping of the data. An API is just a much safer way for banks and fintechs to interact. And there are so many ways that we interact with APIs on a daily basis that people probably don't even realize. But I think this one is really important in terms of granting permission to share your data and not expose credentials. And it just, again, makes it easier for banks and fintechs to work together and provide services more securely. And, with cloud-based products and apps, there's just this whole connected system where data is relayed automatically through this API integration, rather than exposing all of this when you're talking about people's money, where you're exposing all of this sensitive data. And nobody, one of this is sort of like just a public service announcement. You no longer should be giving anybody your login information to anything. That's why people use login with or buy with PayPal, and that's an API. Login with PayPal is an API. Using, even getting a weather widget on your phone, it's an API. We don't have to share all the sensitive information, and it allows for more collaborative working throughout the whole financial services sector. So yes, it was a very obvious one, but one I think that's important to talk about in terms of how it's affecting the industry.
And one person's obvious is another person's And with me just completely doing a facepalm last week on ETF. God, I'm so glad that nobody contacted me afterwards and just said, excuse me, Mr. Moorhead, we're going to take away your license of being an industry analyst. And I'll remind them, hey, I'm an industry analyst, not one of those highfalutin stock analysts or something like that. But I own ETFs and I've traded in ETFs. So whoopsies.
Yep. Well, it also just shows that this is not a scripted podcast. We're not reading from a teleprompter. We're just talking about what's happening.
Got some show notes. It's Friday. I have not had any drinks yet. None, zero, but I probably should. But anyways, so let's move on. I mean, what's coming up this week, Mel? I mean, do you got anything going on? It's either we're going to talk about that or we're going to have to talk about Dwack. Okay, here we're going to do. We are a live show. You're going to hate me for this, but you might think it's funny. Trump's SPAC, Digital World Acquisition Corp, up 600%. Look at it, goes in, it goes down, it goes down. Anyways, sorry, it's Friday. Let's put up the Dwack. No, what's going on this week? Anything new? Anything exciting?
God, there's so much going on right now. You would expect kind of going into the holidays that we would have a bit of a lull, but it just seems like every day there's more happening. There's the Inc. Innovation Summit Festival, whatever it is, coming up next week. We've got AWS reInvent at the end of November. There's so much happening right now.
It's hard to keep up. For me, I don't know if it's the same for you, but vendors pretty much just line all of their meetings on top of everybody else's, and they really don't care that this happens. And when there were live events, you could never do this because you'd miss all the analysts. But
yeah,
next week for me, I have Ignite. I have an Oracle live event talking about some new SaaS applications coming in. But hey, the good news is I don't have 4 events like I had this week. And then, go into GTC, IBM Quantum. It's just going to be crazy. It's amazing. Speaking of NVIDIA GTC, it's incredible how many folks in Fintech are using NVIDIA GPUs to train their AI models just to get that advantage on everybody else. And I'll be interested to see if they have a Fintech carve out there at the show.
Oh yeah, interesting. Yeah, I mean, that actually, one of my recent Forbes articles was about AI and what's happening in Fintech and AI, and that's, as we talked about before, going to be part of a bit of a series. So maybe you'll need to clue me in on that. I do find, though, that a lot of these events, when they, because people are just kind of getting used to going back to events, the events that have the virtual and in-person options are just a lot easier to get a real glimpse of what's happening. And I'm seeing this past week with Money 2020, it was live only, and there's just not enough coming out of it because they limited it to being live in person only. So I think it's smart for people to have the option still of in-person or virtual, especially, people analysts are invited to 4 events in the same week. We can't be at all of them. So the virtual stuff, it definitely is helpful.
Yeah. Here's your Forbes article on AI and Fintech. I love it. Obviously the Forbes counter is down because I don't remember you cranking out 600 views for anything. So,
it's funny. I noticed that too. I was like, usually it's like in the, tens of thousands, not hundreds.
No, I know it breaks every once in a while.
That's all right.
They use Google Analytics on the back end, but I'm sometimes looking at, I feel like it's like pure brilliance that I put there out on the table, and I get 12 people who read it, and then the next day I've got 10,000. So it's
True.
obviously something going on there. But no, it's a great show, and brought a lot to the table here. And until next week, I just want to thank everybody for tuning in here to FinTech Friday with Melody Brew and Pat Moorhead. Have a super week.